Hello, good afternoon, and welcome to today's episode of Modesty's Mortgage Masterclass. This is session number 16 of our Modesty's Mortgage Masterclass, and today we are going to be continuing on our series where we talk about types of mortgage borrowers, and we're going to continue with talking about business borrowers. So this is part 3 of talking about business borrowers, but then part 6 in total of talking about different types of mortgage borrowers, as we've been breaking them down to your understanding, to the very basic level where you understand it very well. Hi Charito, good afternoon, thanks for coming on. All right, so I remain your man Ikenna Umezudike. I'm the director of Modesty Financial Consultants Limited. We're a financial services company based in Luton, United Kingdom. We specialize in mortgages, in financial advice and planning and investment advice and financial consulting generally. Okay, so today, as usual, as we do in our mortgage educational series, we talk about what's the latest development in the mortgage and property markets. Specifically in the UK. Sorry, I don't know about wherever you are in whatever part of the world, but I can only talk about what I know, which is what's going on in the properties and mortgage markets here in the UK. So what's been making the news rounds and what's the latest and what's the updates? That's what I'm bringing you now. First of all, before we go into today's topic, and in today's topic we're going to be looking at another type of business borrower. Will be dissecting the commercial kind of borrowers and the corporate kind of borrowers. But before we get there, let's look at what's going on in the mortgage and properties market. So today we're going to be talking about the information, the news that's come out from Rightmove. Rightmove are the biggest property portal here in the UK. In fact, as at last year they had hi Fanny, good afternoon, thanks for coming on. As at last month, sorry, they had about 5.2 million visitors to their website. That's basically the first place a lot of people go to look for properties when they are searching for properties to either buy or rent. Right, so Rightmove released information on property asking price. So information from Rightmove suggests that property asking price. Hi Phillips, good afternoon, thanks for coming on, brother. So Rightmove, the information from Rightmove suggests that there is an increase of 1.9% in the asking price of properties. Hi Olisa, good afternoon, good to have you here. There's a 1.9% increase in the asking price from sellers on property prices compared to what the levels were. Hi, good day, Olua Phillips. Compared to where they were before the lockdown, right? So pre-lockdown levels, there's a 1.9% increase in asking prices for houses in the UK, as suggested by the data from Rightmove. Now let's break these statistics down and see what it means. So basically, average asking price. First of all, asking price is actually the price at which properties are advertised on the property portals. So if I have a 3-bedroom house and I want to sell it, and I advertise it either through an agent on property portal like Rightmove, who has produced this data for £250,000, that is my asking price. Okay, asking prices might not be the sale price. It might not be the price at which the transaction ends up being consummated at the end. But that's basically what the seller is asking for that house. So Rightmove, the data from Rightmove now suggests that there is a 1.9% increase in the asking prices compared to what it was before the lockdown came in here in the UK. Hi Olisa, good afternoon, thanks for coming on. Yeah, all the way from Norway, good to have you here. All right, so it means that on average the asking price of houses in England averaged £337,884. That's the average asking price for houses in England from the statistics and data supplied by Rightmove. So it means that there's been an increase. So it means that sellers are asking more for their houses than they were asking for before the lockdown came in. So this means that there has been an average increase in the asking price from sellers by more than £6,000 on average compared to March, before the lockdown came in. Okay, so but since the housing markets, since activity started on the housing market again in May 30, remember the housing market was one of the first sectors that was actually opened up by the government as far back as the 13th of May to ease the lockdown, because the government understood how important the property market or the housing sector is to basically kickstarting the UK economy. So since the 13th of May, activities in the housing market has picked up significantly. So Rightmove are reporting that there are over 40,000 sales, house sales that have been agreed since that time, which is very, very significant. Hi Blossom, good afternoon. Thanks for coming on. So the average number of sales per day during the lockdown, the average number of house sales per day during the lockdown dropped by as much as 94%. So the housing market was practically on lockdown. Nothing was really happening. Just a few bits happening here and there, but by 94%, that's how much the average sales per day dropped. But now, since the housing markets, opened up again since May 13, activities have picked up again to the point that, the level of the average sales per day now is just like 3% below what it used to be as at this time last year. That tells you by how much it has really picked up since the 13th of May. So it was like people were just waiting for the government to say, okay, you can view houses again, now you can go and do property activities again, and they just it's been a very, very busy period for those in the housing sector. So now, still talking about house prices. Hi Phillips, you're asking whether the housing market in the US, whether it's profitable to buy now. To be honest with you, Phillips, I cannot tell you whether it's profitable to buy now in the US or not. I can only tell you about the UK housing market. But I would imagine that, at this time, with all that's going on in the US and the lockdown still there, I would imagine that some activities are still going on in the housing market in the US, but the level of activities won't still come back to normal until, and with the uncertainty of the elections and all that, I would imagine that these uncertainties will play a part in what's going on in the housing market in the US at the moment. But I can't tell you whether this is the right time to buy in the US or not. If you are asking me about the UK housing market, I can tell you what the situation is like here. So I haven't got enough information on the housing markets in the US to be able to advise you. Good to see you too, Mirumalugu. Thank you very much. So the still on the housing market and the asking prices. Now, to give you an indication of how how close the asking prices are to what people are actually paying since the lockdown was eased in the housing market here in the UK. Buyers are paying what the sellers are asking for on 98% of occasions right now. That is very, very close. So on 98% of the occasions right now, the buyers are meeting or matching the seller's asking price. So what that suggests that it doesn't look like there is that's too much of a room in negotiation at this moment in time, or just dropping the asking price by so much, because it looks like on 98% of the occasion the buyers are matching the lenders the buyers are matching the seller's asking price 98% of the time, compared to about 97% of the time as at February. So before the lockdown came in, buyers were matching the seller's asking price 97% of the time. But now, after the lockdown, they are even matching the seller's asking price by more times than they were pre-lockdown. So estate agents have never been this busy, for a very long time. In fact, there has been a 40% increase in the number of phone and email inquiries that estate agents have been receiving, according to statistics from Rightmove, compared to what it was, in early March. And there has been an increase in demand for properties with outdoor space. Okay, properties that have got garden or outdoor space, front or back garden or whatever. There have been increase in properties like that. One of the reasons being that people are tired of being confined in their houses. The lockdown has really made people very stressed out in terms of being locked in their properties all through this lockdown. So some people are, while they are now looking for properties to buy, some are looking for properties that have got outdoor, space like gardens and all that, so that they can at least go out and receive fresh air. And so it looks like the experience of people who live in places like flats or places that haven't got outdoor space, it hasn't been a pretty good experience for them during this lockdown, which has actually led to increase in demand for properties with outdoor spaces. So we Rightmove are suggesting that there is increase in demand for properties like that. Okay, so what does this statistics really mean? Let's just break it down and see it from the perspective of different property professionals as well, who are, airing their opinion and giving us what their thoughts are on this. Now, the Rightmove director, Mr. Shipside, basically suggested that these statistics suggests that Britain is getting moving again in terms of the housing sector. The flurry of activities, estate agents getting busier, getting more phone calls and more email inquiries about properties, and then buyers matching sellers asking prices 98% of the time, seriously suggests that people are willing to move on. People are willing to buy properties. People are willing to, make a move, and people are being bolder and more confident. And this is just a reflection of people's level of confidence, right, on the property, in the property market. It reflects what people think about the property market, whether they are confident that the property market and the property prices will remain stable, or that they can actually invest or buy properties at this moment in time. It's all about buyer confidence. So it looks like the confidence from the buyer side is sky high. Okay, now Mr. Shipside also suggested that it doesn't look like there is any sign of panic selling on the side of sellers. So sellers are not too bothered about house prices dropping or falling below the level that they would appreciate. Sellers are confident that this is what their houses are worth, and this is what they are asking for it. Buy it or leave it. So they are not like panic selling. Yes, there is the news of Britain. Britain is already in recession. If you looked at the figure that came out last week about the drop, the 20% drop in GDP of the 20% in drop in the economy in the UK in one single month. British economy dropped by as much as 20%. That's the biggest drop in 1 month since records began. So it's basically frightening. But as frightening as it is, it doesn't look like it's frightening enough to bother people in the housing market, especially sellers. Because when news like this comes in, and when there is so much uncertainty floating around and there is panic everywhere, people kind of panic sell in situations like this. But we're not seeing sign of that panic selling now in the UK properties market, because remember what I said the last time and a couple of sessions ago. I said if you look at what the UK government is doing and the amount of money they are pumping into the economy, as it stands now, a lot of people in the UK are feeling wealthy because the government have pumped in so much money to soften the impact of the pandemic. So even though people are not going to work, there is still money in their account, because the government is paying almost 80%, paying 80% of their income if their companies wanted to lay them off or make them redundant. They'll cover 80% of their income, of their salaries, if the company can cover the remaining 20%. So that furlough scheme is putting money into people's pockets. The bounce back business loan that the government is offering to businesses up to a maximum of £50,000 that you can access through your bank with very 7 easy questions, just ticking the box and filling, and you can access £50,000, and the government is guaranteeing it 100%, right? And then the government have also gone out to pour in over £200 billion through quantitative easing, and then they are buying back a lot of the government bonds and a lot of the government yields, a lot of the government debt instruments. By buying those instruments back, they are paying, people who held those securities and those debt instruments. They are paying them by, therefore pumping money into the economy. So all manner of measures put in place to pour money into the economy. So, and people who are going on to the universal credits now are receiving social security payments from the government while they are still off work. If they can't find work, the government is paying. So about 3 million people now are claiming social security benefits in the UK. That's the highest level it's ever been post-war Britain. So you can see that the government is doing everything possible to cushion the effects, the financial effects of the pandemic. So because of this, the feeling that people have is that, well, there is no reason to panic. So if somebody has a house to sell, they already know that you who's coming to buy that house is either the government is paying part of your wages, so you've got money to spend, or your company is paying you, still have your employment or your job in place, or you're a business person who has benefited from the government support, so you're not really in a dire financial situation. And the seller also would also feel maybe they have benefited from 1 or 2 government schemes, or they don't feel the pressure, the financial pressure to sell below the market value. So they are not really like that motivated to panic sell. So we can see that's why there is no panic selling, and the sellers are relaxed. If you don't meet our asking price, fine and good. We are not selling. They are not in a rush. They are not in a hurry. They are not desperate to sell. And that's why we have seen the increase in the asking price. And we are also seeing the closeness between the buyers matching the asking price at 98% of the time. So there has been worries before now. Some of the sellers have been worried about buyers coming in with an offer that is below the market value for sales that have been agreed before the lockdown. There have been property deals that sales have been agreed before the lockdown. Then when the lockdown is, the sellers of those properties were worried that the buyers will now come back with a reduced offer to say, oh, because of this, because of that, can we renegotiate the offer? But it doesn't look like it's happening at this moment in time. So in fact, on the back of this evidence, it looks like buyers are keen to seal a deal when they see a good deal. When they see a good property, it looks like buyers are keen to seal the deal, because the more you delay, the greater the risk of losing that property. So they can see that the sellers are not in a hurry to sell. They are not desperate to sell. So if you see that these things are not really working the way you want them to work, as a buyer, all you can do is, when you see a property you really, really love and you don't want to miss out on it, you match, and you feel the seller's asking price is fair enough, you match the asking price, you pay for it, and then you move in. So the other factor that has also contributed to this increase in asking price is a shortage of supply. The property market is still a reflection of the bigger economy and general business. Once there is a shortage of supply, there is bound to be pressure on asking price. Once there is more demand than there is supply, it's going to be the seller's market. So at this moment in time, there is shortage of supply of houses, especially family homes or family houses. So the few good ones that are available on the market are going for a premium. And there are too many buyers chasing those few good ones. You might actually be priced out of, in fact, I gave an estate agent a call this morning on behalf of a client who's looking to buy a property. And by the time I called the estate agent this morning, the asking price for that very lovely 3-bedroom house property, the agent told me that That property went on the market just yesterday. By this morning, overnight, they have received more than 12 inquiries via emails, and they have received more than 10 phone calls on that property. In fact, on one of those emails, they have already received an offer on that property before they even come to view the property. The agent doesn't even have the key yet. They haven't even received the keys to the property, but it's already on the market, and people are already making offers. So buyers are keen to tie up good deals when they see them. Okay, so the statistics from Rightmove seems to be corroborating what we are seeing in the property market. So on the strength of this, the other side of it is that lenders have been concerned about the stability of the house prices, which is why lenders have pulled out a lot of their high loan to value deals. So the amount of money the lenders are willing to lend to secure it against that property, the higher end of it, they have pulled out some of those products. So you can see, say, 80 to 85% loan to value from lenders at this moment in time. But the 90s and the 95s are difficult to come across. A few lenders are still operating in that market, but there are fewer and fewer high loan to value deals, products from lenders in the market. The reason being the lenders' concern about the stability on the house prices. So the hope is that with this statistic that has come out from Rightmove, lenders will be now more confident to know that there is a little bit of stability coming back into the property market. There is hope that very much in the nearest future, the lenders are going to come back with these high loan to value products in the market. So nevertheless, this is just 1 month's data from Rightmove. Encouraging as it is for the sellers and in the housing market, showing that activities are returning back in the housing market, and the housing market is bouncing back to life. As encouraging as it is, remember, it is just 1 month's data. So there is a possibility. Hi Cynthia, good afternoon, thanks for coming on. Hi Emmanuel, good afternoon, thanks for coming on. There's a possibility that in the next couple of months things might change. But as it stands, the 1 month data that we have from Rightmove is encouraging. So we just stand on that for now, because there has been really 3 months of speculation about house prices in the UK. What is it going to do? What is it doing? Now we have a 1 full month detailed data from Rightmove on what is actually happening. So it gives us an insight into what the property market is actually doing. So one of the biggest challenges to this positivity, though, is unemployment, right? Just yesterday, the data came out yesterday that about 600,000 job losses have been recorded by the Office of National Statistics. So about 600,000 job losses, 600,000 people have come off companies' payroll. So that potentially could be 600,000 people claiming benefits again, or 600,000 people, living at the mercy of the government's support. So that's one of the biggest threat to this positivity, because the more people lose their jobs, the lesser demand we have for houses and for properties, and the lesser the confidence of people in going out and making big decisions, because house purchase is a very big decision. If people are not confident about their job and the economy and about their income, they will really not be encouraged to go and splash out and buy properties. So that will be the biggest challenge. If unemployment increases, then this positivity, we could just see a bubble somewhere along the line. Also, if lenders pull out many more products out of the mortgage market, that again is going to affect this, because if people can't get mortgage, there isn't enough mortgage product to service people's appetite for buying properties, then actually this whole positivity will mean nothing. You can view all the houses you want. If you can't get a mortgage to buy them, you just cannot buy them. But at the moment, we're seeing positive things happening in the property market. Shortage of supply of properties, of houses, is another issue that is also going to be challenging for this positivity we are experiencing. We have seen shortage of supply of family houses, and a lot of people not wanting to move to family houses with outdoor living space. So, and because of the lockdown, all the construction sites were basically put on hold during lockdown. So it has really affected the supply of properties, of houses. But now that builders have gone back to site, property activities have returned back, we are hoping that there will be more properties coming onto the market. But if the supply doesn't increase anytime soon, then basically there will still be much more demand. But the demand and the supply have to match each other for us to have some level of stability. Because if there is shortage of supply, obviously there will be increase in house prices. But then if that shortage of supply is also met with high unemployment levels and low mortgage product availability, really doesn't mean anything, because it means that the buyers cannot actually execute the purchase of those properties. Okay, so and the highest hit sector people in this whole thing are the first-time buyers. First-time buyers cannot find enough mortgage products, like the high loan-to-value mortgage products, to be able to get mortgage to buy properties. And then first-time buyers are the people who buy mostly flats. But there are fewer flats coming onto the market at the moment as well. So it looks like the market for first-time buyers is a little bit tough at the moment, except you can come up with at least 10 or 15% deposit of the property. For first-time buyers with whom cash is tight and who depend on 90 or 95% loan-to-value mortgages, if they can't find enough of such products available in the market from the mortgage lenders, then their chances of getting on the property ladder become slimmer and slimmer. All right, so let's now go straight into the into today's topic, where we're talking about business borrowers part 3. Okay, last week we talked about SPV, special purpose vehicles. Today we're going to be talking about corporate borrowers. Now, corporate borrowers basically are limited companies. So when limited companies borrow money to buy a property, they are classified as corporate borrowers. Okay, so they could borrow for either residential or for commercial purposes. So as limited companies are owned by the shareholders, and then they have directors. It could be a one-man director, it could be a two-man director, as many directors as they want to have, and then shareholders as well. So the shareholders own the company, and then the company will now borrow the money in the name of the company. So there is separate legal entity from their shareholders. So when lenders are lending to these corporate bodies, they are lending to that corporate entity and not to the individuals that own those corporate entities. So the loan is advanced to the company, not the individual. When it comes to mortgages, the company owns the property, not the individuals. So the individuals are only exposed to as much as the shares that they own in that company. Therefore, they own the shares in the company, and the company owns the properties. So as we discussed last week on SPVs, when we're discussing SPVs, the limited companies are owned by directors and shareholders who own shares in these companies, and those companies now own the property. So that's what corporate borrowers are. So how do lenders now treat these corporate borrowers? What they do is, when lenders are assessing borrowing from limited companies, there are a few things they consider. They look at the company. If the company is involved in other things, say you have a limited company that sells cars, and you want to use that company to buy properties. Now, the lender will assess the risk of lending based on the activity of that company. And as I said last week, lenders prefer to lend to limited companies that are SPVs, like special purpose vehicles, that are dedicated to property investments, because they know that the income for this business is solely based on properties, and they can easily assess that, and they know that whatever will affect the performance of that business will first of all affect the property, which is the sole thing that it does. But in this case, it differs from SPVs. It means that you are a limited company, say your company sells cars, and then you want to use that limited company to buy properties. So what the lender will now have to assess is not just the property you are buying and the viability of it. If, for example, you are buying it for investment purposes, they are also going to be concerned about the viability of the actual business that that company is doing. So if anything happens to your car business, potentially it's going to affect the business. And the lender's stake is on the property that you're buying. So to the lender, it presents a higher risk for them when they are lending to limited companies that are not SPVs. So there are some lenders that will not lend to any limited company that is not an SPV to buy a property because of this risk that I have explained. Because they are concerned about what's going to happen if anything happens to the other side of the business that you're running. There are other lenders also who are happy to lend to limited companies even if they are not SPVs. It means they have a bigger appetite for risk. But then the interest rate might be a little bit higher than usual, and then they might want to lend you a lower loan to value compared to what they would have ordinarily lent to other class of other customers. So the loan they will give to you will reflect the amount of risk they are willing to take. So they might want to lend you, say, 70% loan to value as against 75% loan to value, or 65% loan to value. In this pandemic period, really, they are cutting down on their loan to values because the lenders are not yet, very much keen on taking as much risk as possible. So wherever they can cut their risks, they would like to cut it. And for limited companies who are corporate borrowers who already present a high risk to them, they want to cut their risk even further. So there are limited options for limited companies if they want to buy, say, for example, to buy as an investment property. So you will find more option if that limited company is an SPV than if that limited company is just a limited company that you're using for other purposes. So the company will also, the lender will also assess the ability and the authority of the company to borrow. Every company that is set up, every limited company, has a memorandum and articles of association. That memorandum and articles of association spells out what that company is empowered to do, including borrowing. So your memorandum and articles of association will have to also empower you, authorize the company to be able to borrow. So the lender will also want to scrutinize that to make sure that the company has the authority to borrow as enshrined in their memorandum and articles of association. They want to examine these documents and make sure it covers that. The lenders will also want to examine the powers of the individuals representing the company, because if you as a director wants to sign off this loan on behalf of this company, you have to have the requisite authority to do that. So the lenders will have to ask to see what authority you have to sign that document off. A lot of lenders will ask, what percentage of shareholding does this person have in this company, and do you have the right to sign just on your own? If you're a majority shareholder, if they need only one signature, or they need all the directors in the company to sign, they have to assess the authority and the power of the person who is signing it to do that. So some lenders, basically, like I've said before, they are not really too keen on lending to limited companies for property purposes unless they are SPVs. But they have to do these due diligences to make sure that all regulatory and legal requirements are covered. Okay. Now the risk that your business poses to the lender is minimized by the due diligence that they carry out on both the individuals behind the business and the business itself. So do not think that because, I'm separate from the business, the lender will not know. They are going to assess the moment they accept to lend to that limited company, they will look at the limited company and they will look at who is behind the limited company. Because they understand that even though the company is a separate legal entity, separate from their shareholders, but somebody is running the company. The company is not running itself. So they're going to run their checks on the individuals. And the other thing is, when you can register a limited company today and use it to buy property today. So it doesn't have to be a limited company that has been trading for so number of years, especially if it's a buy-to-let investment. If it's an investment property, you can register it today and use that company to buy property today. As long as it meets all the regulatory and legal requirements from the lender. So it's not, there's no prerequisite for you to have, for the company to have traded for a number of years before it can buy property, as long as it's a limited company. Okay, so many of these lenders, now many of these lenders do go as far as requesting or requiring personal guarantees from the directors. Now, personal guarantees simply means that the directors are saying to the lender, if the company does not pay the loan, I will pay. So to give the lenders further security and assurance on the money they are lending to you, they are not just gonna, some lenders are not just gonna lend you that money and say, okay, we have lent it to the limited company and that's it. Some lenders will go as far as saying, we need a PG, a personal guarantee. If you can personally guarantee the loan, then we'll approve it. If you can't personally guarantee it, then no way. So if you are happy to, stick your neck out and say, oh, yes, I will personally guarantee it. If the company doesn't pay, I'm going to pay, right? It's only when they lend, if in the event of default or the company goes out of business, you are now going to be liable for that loan or for that mortgage because you personally guaranteed that loan, right? So if the company goes out of business, you cannot say to the lender, oh no, I have nothing to do with it, it's the company's liability, I'm a limited company, my risk and my liabilities are limited to my shareholding. No, the lenders are going to request for the personal guarantee you gave to them covers that. It means they can come after you, your personal assets, if the company does not pay up. So it's something for you to think about if you want to go into that relationship with the lender, okay, because it offers the lender extra security on the loan that they're advancing to you. So corporate mortgages are in the classes of unregulated mortgages. Remember, we talked about regulated and unregulated mortgages in the last session. Unregulated mortgages basically mean that there is no the borrower has no rights to complain to an independent arbiter like the financial ombudsman. Hi Edkin, good afternoon, thanks for coming on. There is no consumer right protection for the borrower. It is assumed that it's a business decision and that before you made that business decision, you knew what you were getting yourself involved in. So by making it a purely business decision, you are waiving your consumer rights, your consumer protection rights. In that, if anything goes wrong, you cannot go and complain that, oh, I was given the wrong advice. No, it's a business decision. So that's what unregulated mortgages are. So when business mortgages are unregulated, it means that the regulatory bodies in this country do not actually oversee and overlook those activities that's surrounding that the mortgage decision. It means you are making that decision knowing fully well what the risks are. So it's different from personal loans or personal mortgages and residential mortgages that you are borrowing in your name. Okay, I hope that's clear enough. So corporate mortgages or mortgages lent to or mortgages taken out by limited companies are unregulated mortgages. Now, for building societies in the UK, there's a restriction for building societies when it comes to corporate mortgages. Building societies are different from banks. They are banks, but they have a different structure, right? They are not like full commercial banks. Now, building societies, their level of exposure to commercial loans, like lending to limited companies, is limited to 25% of their whole commercial assets. So a building society cannot lend more than 25% of their whole commercial assets to limited companies. So if a building society exceeds, or if they run out of that proportion of cash, they will cease lending to limited companies in that financial year and until another financial year. So that's some kind of limitation. So you see that some building societies are more strict when it comes to lending to limited companies. If they must lend to limited companies, it must be worth the risk because they know they've got limitations on that end. Now, the other type of business borrower I want to quickly talk about before we go is commercial borrowers, like commercial mortgages. Now, commercial mortgages are mortgages that are secured on commercial properties, like shops, factories, and offices and all that. So if anybody wants to buy a shop or an office or a commercial building, there's a different kind of mortgage that takes care of that called commercial mortgages. It's different from residential mortgages. Okay, so it's secured against commercial buildings. Now, some commercial mortgages have an element of residential in them. For example, there might be a flat on top of it and then a shop at the bottom of that building. If it's a combination of residential and commercial, it's called a semi-commercial mortgage. So there will be a combination of residential and commercial elements to it. So it becomes a semi-commercial mortgage. Now, when lenders are assessing semi-commercial mortgage, they will assess the level of income from both sides or from both parts of that element. The residential part of that building, they want to know how much rental income is coming on from there, and then the commercial part of that, how much rental income is coming on from there. So they will assess both values to make a lending decision on whether it's viable enough for them or not. Now, an individual or a company can take out a commercial mortgage. An individual can take out a commercial mortgage for investment purpose, or you can borrow as a limited company, as a corporate body for for investment purpose as in a commercial mortgage. Now, in assessing a commercial mortgage, what the lender do is that they will assess the status of the individual. If you're buying it as an individual, they will assess your status as an individual. They will look at your experience in running that kind of business. If you have owned commercial mortgages before, or even if you haven't owned commercial mortgages before, they want to look at your experience in owning properties, investment properties. What sort of investment properties do you own? Because trust me, there's a difference in running residential investment properties and running commercial properties. If you don't have that experience, it might be rough in the first place. So the lenders want to look at that level of experience before they make their lending decisions. Even if you haven't got experience in running a commercial property before, the lender might still lend you based on your past experience of running residential properties. Yeah, if you're an experienced landlord, they can leverage on your experience to say, okay, well, you can use that experience to run this commercial property. But for a first-time investor, lenders are really skeptical about lending to a first-time investor who hasn't got experience in managing any property to manage a commercial property. It's usually a tricky one. It's not impossible, but it's a tricky one for lenders to decide to do. So they will assess your individual circumstance. They will also assess how would this extra borrowing impact on your already existing commitments. If you've got other buy-to-let mortgages, they want to look at those other buy-to-let mortgages or other loans that you have. How will this impact on you personally? Are you over-leveraged, or what level of leverage are you currently on? So they will assess all that. And then for corporate bodies, they will also want to assess they will do the normal due diligence that they do on corporate bodies. They will look at the setup of that corporate body, who is behind the corporate body, who is behind the limited company, what powers do they have to borrow, on the track records of the company. If it's a new company, that's fine. You can still borrow in the name of that new company to buy a commercial property. But again, it all boils down to experience of the people behind the limited company. So the lender will now seek to know how this extra borrowing on you as an individual will impact on your overall financial picture. Now, if the lender assesses the viability of that proposition and they find it viable, then they can make a lending decision based on the viability of that. In most cases, affordability of that proposition is not usually based on the income of the borrower. It's usually based on the rental income generated from renting out that commercial property. But for commercial mortgages, sometimes it could be an owner-occupier situation. Say, for example, a dentist wanting to buy a property to run a dental surgery or a dental business from that property. The lender will look at the viability of that dentist business. If that business has been in existence, they want to see the books. How has it been run over the years? If it's going to be a new one, they want to see like a business plan, financial projections, and then the experience of that dentist in and how they want to set up the management structure in that business. So they want to see all that put in place before they make a lending decision, because the loan is going to be secured on that property. But that property is dependent, servicing that loan is dependent on the income generated from the activity that is going on that property. Okay, so if it's going to be an owner-occupier property, then the affordability will be based on the income generated from the business that's going on in that premises. So on that basis, they will want to see the books of that business. But then if you are just borrowing that money to buy the property, to rent the property out, the lender will not be that much interested in seeing the books of the business that is being run on that premises, because as long as the rental income can cover the interest or the mortgage repayment every month on that particular loan, then that's fine. And that brings us to what we call the ICR, the interest coverage ratio. So if the ICR as calculated by the lender meets the lender's criteria, in this case for commercial mortgage, they might be looking at say 125% or 145% depending on the lender's criteria. What it means is that the rental income plus an extra 25% on top of it should be enough. So after paying the interest, there should be like 25% on top of the rental income for it to be able to cover for it to be able to meet the lender's criteria to lend against that. So if, for example, the interest is £100, the rental income, if the interest coverage ratio is 125%, it means the lender is expecting that the rental income from that property should be at least £125. Okay? So if the rent or the mortgage repayment you are expected to make to the lender is £100 every month, the lender will say, for us to consider this a viable lending option, the rental income from this property should be at least £125. So that by the time you pay us the £100, there should still be at least 25% left on top of the rental income to justify that it's a viable lending proposition. So if the prospective borrower is buying the property to rent it, that's what the lender will be looking at. But if they are buying to use it, the lender will be looking at the business that is going on that premises. So the lender will now, if you are buying to rent it or to use it as a business, the lender will want to see things like, what kind of tenants are you going to have on there? What kind of contract are you going to have with those tenants? The lease agreement or the leasehold agreement that you have with that tenant. We want to see what's the content. How long are these tenants willing to stay in that property? Because they just want to know what possibly the void periods are going to be and what measures have you got in place for you to cover the void periods. Now, if you want to invest as a property investor, it's usually advisable for you to have some kind of emergency fund somewhere to take care of some void periods. Some lenders do require this. They want to see some kind of savings for maybe like 3 months, at least 3 months worth of the rental value of that property in some kind of savings account. Because the reason they are doing that is if that property is not yet occupied, when you buy that property, you will have to put it on the market and advertise it for people to come and rent it. There is a possibility that that property will be empty for the next 3 months or thereabouts before tenants occupy that property. So lenders will want to know, in that void period, have you got enough money somewhere to take care of the mortgage repayments while you get tenants into the property? Yeah, so they would like that kind of extra security to say, okay, yeah, you've got about 3 months worth of rental income. So if you're asking for £1,000 on that property, the lender want to see maybe £3,000 worth of savings in an account before they approve that loan, just to make sure that you've got all those contingency plans in place. Okay, so these are the things that the lender will analyze before they make lending decisions if you're taking out a commercial mortgage. There is more to this than what I have just said, but because of time constraints, we're just going to stop here today. But I hope that you've been able to pick up one or two things about how lenders look at commercial borrowers and corporate borrowers. So thank you very much for coming on today, and thank you for being part of today's session. And I hope this has been useful to you. And if it's been useful to you, we are always keen to find out what you think. So you can drop us a comment on whatever platform you're watching this. Search me on YouTube, Ikenna Umezudike. There are lots of catalogs of contents on my YouTube channel that you can listen to. Our Monday sessions that we talk about money, it's all on my YouTube channel. Our Wednesday sessions where we talk about mortgages, they're all on my YouTube channel. Subscribe and tell us what you think. And I'm available on any social media platform. You can find me on Twitter, on Facebook, on LinkedIn, on Instagram, and on YouTube. Just type my name out on any of those portals. Follow me, tag me on your post, and let me know what you think about what we're doing. And let's connect. Let's do something. Our aim is to educate our clients, our customers, our friends, and bring them to a certain level of financial exposure and education, and help them make better financial decisions. Until next week, thank you so much. God bless you, and take care. Have a lovely day. Bye now.